In this video, we will dive deep into understanding capital gains tax on investments. We'll cover fundamental questions, scenarios, and tax implications to help you become more informed about your investment taxation responsibilities. In this video, we will cover the following topics. First, we'll start by defining what capital gains are. Next, we'll look into how to calculate these gains. Then, we'll discuss the tax implications of selling investments. We will also differentiate between long-term and short-term capital gains and their respective tax treatments. And finally, we'll look into tax reporting requirements for capital gains. Capital gains taxes are those levied on the profits made from selling assets, such as stocks or mutual funds, for more than their purchase price. It's important to understand that only the profit, or the gain, is taxed, not the entire amount received from the sale of the asset. Knowledge of capital gains tax is crucial for managing and planning your investment strategies effectively. Let's see what you've learned so far. Here's a quiz question. What are capital gains taxes applied to? A. The entire sale amount. B. The profit made from the sale. C. The purchase value, or D. None of the above. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is the profit made from the sale. Capital gains taxes are applied to the profit made from selling the assets. Only the profit is taxed, not the entire sale amount. To calculate your capital gains, first find the difference between the price at which you sold your asset and the price at which you bought it. This difference is your gain or profit. Depending on the specific transaction details, the method of calculation can vary, especially in cases of multiple purchases at different prices, dividends, or reinvestments. Thankfully, your brokerage usually provides the pertinent information, simplifying this process significantly. When you sell investments, you only pay tax on the profit made, not the original investment amount. For instance, if you initially invested $10,000 and it grew to $11,500, and you then sold $2,000 worth of stock, taxes would only be applicable on the profit of that particular $2,000. Your broker will provide detailed forms that will explain your gains, making the tax reporting process straightforward. In this diagram, we illustrate the different holding periods that define long-term and short-term capital gains. Investments held for over 1 year are categorized as long-term and typically enjoy a lower tax rate, whereas short-term gains from assets held for a year or less are taxed at the ordinary income rate. Your brokerage will usually send you a Form 1099-B at the start of the tax year. This form will report sales and the cost basis of the assets sold, providing a streamlined approach for calculating and reporting capital gains. For accurate tax filing, it's advisable to consult with a financial expert or tax professional. Let's summarize what we've covered about capital gains tax. Capital gains occur when there is profit from the sale of assets. The taxable amount is the difference between the sale price and the purchase price. Taxes apply only to the profit segment of your investments sold. Forms. Always consider consulting tax professionals to ensure accurate reporting. Thank you for joining us in this insightful exploration of capital gains tax. Don't forget to like the video, share it with fellow investors, and subscribe to our channel for more content like this. Share your thoughts or any questions in the comments section. Happy investing!